Excellent. 11:01. We got a lot of folks already tuned in. So as I mentioned, we got a lot of material to cover. So let's go ahead and get rolling here. Thanks for joining us today, and welcome to our market and economic update entitled Inflation, Inflation, and Inflation. If you don't know, my name is Jason Dahl. I'm a certified financial planner and a partner at AFS Financial Group. I'm here today with my colleague, Alp Atabek. Alp is the founder and managing partner of AFS. I know we have a lot of folks tuning in from the 401k side. So as a quick reminder, Alp and I, we are with AFS Financial Group primarily, when we operate as a separate entity from the AFS 401k retirement services team, but we often collaborate, especially when it comes to financial wellness programs, webinars, workshops, such as this. And for today's session, we're going to use a series of JP Morgan charts and graphs that depict important market and economic data that will set the framework for our conversation on what you need to know in terms of the current financial landscape. And there's a little bit going on out there. And with attention particularly on the high inflation environment that we are experiencing at hand, as well as what to expect as the final quarter of the year unfolds. Lastly, as a quick reminder, please ask questions at any time during today's session. We will keep everyone on mute, so you can ask a question by typing it into the chat or Q&A box. I know some folks have already acknowledged that, but if you go to the little toolbar, there should be a Q&A box you can click on. That'll open a little dialog box so you can type in your question at any time. Of course, one of our favorite questions is, can I schedule time to speak with you, Jason and Alp? So we definitely encourage you to do that directly after, as a follow-up with today's webinar. If you have further questions or would like to schedule a time to connect, we definitely love what we do, even in times like this, in these markets like this. But really the best part of what we do is connecting with people and helping you solve personal financial planning and investment puzzles. So please don't hesitate to reach out. This is being recorded. We will download the recording, package it all up. Natalie and our team will get that out, the link out to everyone who tuned in, who wants it. I know a lot of folks asked for it who weren't able to tune in, so we'll be sending that out, and feel free to forward and share with folks as you please. Awesome. All right, we got another chat here. Appreciate it. Very good. So without further ado, let's get going here. The obligatory disclaimer, right? A couple things it's important to note. Hey, this is as of September 29th. The charts will be as of the last couple days, but it's all, if you're listening to the recording, just obviously be aware of that. And this particular presentation, of course, is not meant to be an endorsement or recommendation for any specific investments, right? The presentation is for educational purposes only, but we're happy to, have conversations, right, that are one-on-one specific to folks and their individual needs and portfolio. Sometimes, Warren Buffett's quotes get used a lot. He's very quotable, and some of you are probably familiar with this quote. The market is the most efficient mechanism anywhere in the world for transferring wealth from impatient people to patient people. I think it kind of lays the framework pretty well in an environment like this. It definitely tests our resolve, all of our collective resolve in a market like this, our investment resolve. We're going to talk more about this, but I think this quote does a really nice job of just kind of reminding us that patience is an important virtue, especially in investing. It's not, it's not the end all be all. We're going to talk about different specific moves and things, strategies, folks to consider. But that is an important underpinning to everything we're talking about. Here's just kind of a quick, kind of outline of some of the key topics we're going to talk about today. Right, inflation, rising rates, recession fears, investor sentiment. Right, we're all a part of that. Right, we all have a sentiment related to the markets and investing right now, and obviously the continuing saga and unfortunate kind of wild card that is Russia and the war in Ukraine. And so that kind of lays the framework for today's conversation. And so, Alp, I thought I would start here before we get into some of the slides with probably one of the most common questions we get in conversations we have, some of the kind of captures some of the sentiment of the questions we received ahead of time, and just simply, what's driving the current market action?
Well, I think you can look at the title, right? It's all about inflation and, of course, interest rates, which is the only tool the Federal Reserve has to combat inflation. We haven't dealt with high levels of inflation for 40 years, and there is no blueprint for how you battle inflation when you are still operating with a fractured supply chain, a pandemic that is still affecting output in China due to their zero COVID policy, and of course, the wild card of them all, Putin and the war in Ukraine. Wall Street likes to model everything in. They cannot model all of that in and have any confidence. And so this is a problem, and Wall Street hates uncertainty. And if there was a way to model in exactly what the Federal Reserve has to do in order to control inflation, the markets would quickly price it in, and it would simply be a waiting game for the inflation to moderate. Unfortunately, there's not, I hope I'm not aging myself, there's not a Staples easy button to push in this scenario.
So kind of building on that, I know we're going to talk more about this, but if you want to just kind of give us a tip of the iceberg, if you will, like, so what's really the purpose of the Fed raising interest rates, right? What are they trying to achieve?
So the goal of raising rates is simply to reduce demand, and I'll say of pretty much everything. If we're basically operating in still a fractured supply chain, there's just no supply of things, and so they need to reduce demand. It's working. Easy examples, think of mortgage rates. If you're looking to replace your current home, buying up or downsizing, you are not going to swap your 3% 30-year mortgage for a 6.5% 30-year mortgage. It just doesn't make sense. It's not a big deal if you're a cash buyer. So housing demand, again, while home prices are dropping, they remain high, and you combine that with a 6.5% mortgage rate, you've now priced most first-time home buyers out of the market. And you think of what that impacts, like mortgage lenders, real estate agents, settlement agents, new home purchase related products, paint, appliances, contractors to do the work. By somebody not flipping a house, there's a lot that will be affected in the economy. Think of home equity lines. Are you going to take out a typically variable rate home equity line to pay for a home renovation at today's higher rates? You can think of how many people that finance home renovations through that method, and it's just been very easy because the home equity lines were just so low for so long.
Mm-hmm.
But I will say the one thing that I think the Federal Reserve is being very impatient on is the impact of increasing rates is not immediate. It takes time for it to filter through the economy. So you could still see a lot of activity in your neighborhood from people renovating. It's the future products, or future, I'll say projects that are dependent on financing that will be put on hold.
And as you commented, right, the Fed's single tool, most powerful tool, raising interest rates, can only impact the demand side, right? It can really has next to no impact on the supply side. We know supply chain issues continue to be a problem. And Alp, would you agree? Sort of put it another way, productivity needs to increase, right? Like that's the other side of the equation to help get us out of this current market environment, is increased productivity. Now, of course, that could be through fiscal policy, but that's for another conversation. Probably not gonna happen anytime soon right now. Very good. So, Alp, do you want to now take a moment to kind of do a little compare and contrast, kind of how you would compare what we're going through currently with the credit crisis?
I'll say it's a lot different as to the cause of the malaise. A simple summary of 2007 to 2009, there was an enormous amount of bad debt, and it was everywhere, and it was hidden. Basically, the no document loan underwriting wasn't that great of an idea. I joke when I say that. Today, though, when you look at real estate valuations that are excessive, the big difference is the credit scores for loans over the past few years have been tremendous, all above 700. And if you look at today, and we've kind of already talked about it, it's just inflation, interest rates, the supply chain, COVID still lingering because of China's zero COVID policy, and of course the war in Ukraine. So those are the big differences. Back then, it really was about bad debt hidden everywhere, and that's not the case right now.
My favorite, the ninja loans back then, that they no income, no job. Hey, you want a mortgage?
We got it.
We got it. That is not happening right now. So let's dive into some of the numbers and the data here in the charts. So just a quick lay of the land, what we're looking at here. This is a chart of the S&P 500 index going back to 1996. So just a quick walk down memory lane. If those of you recall, right, the late 90s run up to the tech bubble that essentially burst in early or first quarter of 2000, the subsequent sell-off, and then around late 2001, early 2002 started to recover in the U.S. equity markets up into the credit crisis that Alp was just talking about, right? You sort of see that peak before the sell-off in October 2007. I started working with Alp in November of 2007. It was great timing. Obviously the significant sell-off bottoming out in March of 2009. And we're going to come back to some of these other figures, the price to earnings ratio here in just a moment. But then this long, good times, right? Obviously there were bumps along the way. It wasn't all up, but you see a definite trend line going into February 2020. Of course, that was essentially the start or the impact of the pandemic in the markets, right? Selling off. Very fast sell-off. In fact, it was the fastest reversal from a bull market to a bear market in history. And then, we had this, what everybody loves to describe, the V recovery, which also became the fastest turn from a bear market to a bull market in history. And this really strong, almost vertical move up to basically the end of 2021, beginning of 2022. And then that was essentially all-time highs. Most folks' account statements were at all-time highs. A lot of folks are at the end of the year. And then here we are through this 27th of September, right here on the far right. So I think, Alp, you wanted to add some comments sort of talking about the price-earnings ratio?
Yeah, I think when you take a look at it, like one of the big differences today versus, I'll say, the tech bubble, March 24th of 2000, on the left side, the forward price to earnings ratio. And just to refresh everyone's memory, the higher that number is, the more expensive a stock, or in this case, an index is. So at 25.2, that was considered on the high end, and it's been the highest, I'll say, in the entire time we've been
on this chart. Right.
Going to the middle of the page, the forward P was only 15.1, and you can actually see how cheap it was at the bottom of the market, March 9th, 2009, forward PE of 10. And that's when Warren Buffett was pounding the table, telling people he's buying stocks. He thought they were cheap. It was a good idea for others to buy it. So again, low PE was very reasonably priced market. And you fast forward to today, and we now get these slides updated. We can generally get them within a couple days. It used to be only at the end of a quarter. So we have through September 27th, forward PE is 15.4. As I mentioned, October 9th, 2007, not that expensive, not that expensive. One thing that we think that is interesting here is, though, Jason mentioned that we went vertical here after we had this clearly defined trend line. Our thought was at some point, since we saw a break in this trend line, that we would come down and revisit the trend line. And what's interesting is we're kind of hovering around those levels right now. We might break down below it if the selling continues, but it's interesting that we've erased that vertical move. But if you just focus on the forward PE, the next slide gives you the 25-year history of that forward price to earnings ratio. And you can see in the middle of the page, average is 16.85. On the right side, we said it's 15.4. And you can see how much higher it was on the left side with the tech bubble. But I'm going to throw out one caveat right now. And this is all based off of the current earnings estimates out there. If we end up having a recession, and it affects earnings substantially, that means if earnings come down, if the market stays the same, that means the price to earnings ratio will actually go up on its own. So the question is, how much of this is already being priced in to the market today? And sometimes it's a lot easier when you're looking back a year or two from now after you get all the data to see how much was actually priced in.
You used a phrase, if we end up having a recession. Another common question we get is, well, aren't we in a recession, or when are we going to be in a recession? It's a great debate. It's somewhat irrelevant in some regards, but as we were talking ahead of time, it kind of depends on what sector you're in, right? Alp, you talked a lot about sort of housing and all the ripple effect of housing and all the different folks that are involved in there, and that they're probably in a recession, right? Consumer spending, a lot of the areas aren't, right? So it's not as clear cut as just simply saying, hey, we're in a recession or not at this stage.
Yeah, no question. Like certain industries. I think Jason, you told me a story just the other day about somebody you knew that was
related, right? Kind of connected all the residential housing, right? A friend who's a DC based, about a 7-person residential architectural firm. 2 of the 7 just got laid off this week, and they're just not seeing really any activity right now after many years of really strong activity, right? Just, I think that kind of anecdotal, that's a sign of a recession for that firm, certainly in that sector.
And if you're in I'll call it the mortgage refinance business, you're in a depression. It's not a recession, right? Because refinancing is it's not even there right now. It's completely fallen off a cliff. So this is just a great slide that shows you the difference between value investing and growth investing. So I'm focusing on the left side of the screen. Let me get a little water here.
Yeah. On the left, value versus growth with the relative valuations.
Yeah, so when you see the green line going across the middle, basically when the black line is above it, growth stocks are cheap and value stocks are expensive. And what's below it, value stocks basically are cheap and growth stocks are expensive. And so we went through this big period, I'll say from about 2015 on. What really drove the market was all the growth stocks, the Apples, the Amazons, the Microsofts, the Facebooks, the Teslas. Basically, they ran the markets. It was their action that actually was driving the indexes higher. And so basically a big rally in growth stocks. Value stocks did not participate that much. And so that's why you're seeing value stocks, and we'll show a couple slides up, value stocks have performed better in this downturn. But to be fair, they dramatically underperformed the growth stocks for 5, 6, or 7 years. But right now, the market has shifted. Value stocks look attractive. People are running to them for safety. So this is also a great slide of like how history repeats itself. So this is the price to earnings ratio. We're focusing on the left side now. Yeah. Of the top 10 stocks in the S&P 500 versus the remaining stocks. And the current stocks that are in the top 10 are Apple, Microsoft, Amazon, Tesla. It's written on the bottom. Google gets listed twice because they have 2 share classes. Berkshire Hathaway, United Health, Johnson & Johnson, ExxonMobil, and NVIDIA, the chip stock. But you see this period, this was so similar to what happened in the tech bubble. So if you're on the far left, that is the tech bubble. Those stocks were actually running the show back then. It was a different cast of characters, but the top 10 stocks were just the dominant stocks. They were the only stocks that were really doing well. And then you see that basically reversed out after the tech bubble burst. And the market basically, all 500 stocks were kind of trading in tandem with each other. And then we had the same thing happen, a little history repeating itself, where you saw the top 10 stocks. And this time it was all those stocks that I already mentioned, mostly driven by the large growth names, way outperforming the rest of the market, and they got expensive. The rest of the market was not participating as much, but now you were seeing that reverse out. And so the question is, will history completely repeat itself, and will it fill that gap and start trading in tandem for a while? I'll call it in the aftermath of what we're dealing with. So on the right side, sorry. So it just shows you the weight of the top 10 stocks in the S&P 500. This is just an example of like how big those stocks have become. So this basically is telling us on September 27th, the top 10 stocks were almost 30% of the index. And to put that differently, the remaining 490 of the largest stocks in the S&P 500 made up 70%. So top 10, 30, 490, 70%. So you can understand why that gap possibly.
And an even greater weighting than in the tech bubble.
No question. So this is just a great slide of just giving us the year-to-date numbers. I'm right on the focus top middle. And so you can see large cap growth, the Apples, the Amazons, et cetera, year to date through September 27th, down 29%. All the growth side of the equation, mid, small, this is the US markets, all down about 29 or 30%. The value stocks down a lot less. And actually, if we'd have done this presentation about 3 or 4 weeks ago, value stocks were actually much healthier. Things have sold off in total more recently. So this last lay down has kind of dragged everything down. But things that we like to look at, though, is if you compare us on the bottom left, since the market peak February 2020, so pre-pandemic, large cap growth names are still up through September 27th, around 15%. But you can see mid growth, small growth, these are now down compared to that period. And value side of the equation, you can see value, and blend is basically a combination of the two. Value side of the equation, you can see still up a little bit. And another way of measuring is, this is called the current, on the top right, the current price to earnings ratio. So this is the 20-year average, and it's breaking down the segments again, large, mid, small, value, blend, growth, just like on the other side. And so it's telling us that historically, the 20-year average is 18.6. The current PE for large growth is 20.9. And so you can go across this and you can see that market's actually not that expensive compared to a 20-year average right now. And small companies actually selling at a discount. They put all this in percentage terms down below. So if you look at the bottom right, small companies are actually selling at a discount now to the 20-year average. And we had actually sold out of small caps for a while and have entered back in when we started seeing this valuation. So basically selling at a 1/3 discount to 20-year averages. So really fascinating slide.
Yeah, right. It's not necessarily saying, hey, we know we called the bottom in small cap, right? But it's like, hey, they're at a discount, enough of a discount, it's worth getting back into. Could they go down further? Sure, but in the short term. But we feel confident in the longer term, they're at a good price point.
I don't know, Jason, you like this one? So I don't know if
Sure. This is a busy slide, but let's just what we're going to first focus on, that like the title refers, returns and valuations by sectors. So across the top, you have the various sectors that comprise the S&P 500 index, right? So you see these numbers added up come to 100%, of course, right? So here's the weighting of each sector. So energy represents 4.3% of the S&P 500 index, right? So you come across, you got energy, materials, financials, industrials, so forth, right? Consumer discretionary, all right, all the way across. And now let's jump down here to the year-to-date numbers. Right, so that's what we just want to focus on here for a moment. So year to date, what has each sector performed within the S&P 500? Energy, that's gotten a lot of headlines, had a very strong year. In fact, it's probably the only sector that's had a strong year this year. In fact, it is. At one point, utilities were also in the positive, and they were the only other sector positive, but you go look across that, there's really been in the equity markets outside of energy, there's been no place to hide, right? It's been a common phrase this year. We'll add on to that here in a little bit, but you see, the S&P in total is down 22.6, and you see each of the different sectors. Communication services, that's the newest sector that was added. It was kind of broken out from the tech, think of like Google, Facebook, they were added here, and that's where most of the pain has been.
Where most of the gain was previously.
Where previously the gain had been. That's right.
Between communication services and tech, largest part of the gain. Right. Again, you can kind of think of those for the most part as the large cap growth weighting.
And here on the previous slide, Alp referenced that marker of since the market peak, right, prior to the pandemic sell-off in February 2020. Here's just kind of the actual returns since then, and everything is still positive outside of real estate, right? So we're every sector.
Communication services, excuse me.
Thank you. Yep. And communication services, and of course, as a whole, the S&P is still up relative to that point, right? So I know it's painful looking at it from the beginning of the year, but it's about perspective, right? If you go looking at it from February 2020, the market is still up from then.
And I think that's a good point. When you talk about looking at it from the beginning of the year, and we had seen that vertical climb in the market, if you look at it as, well, maybe some of that wasn't really warranted, and now obviously makes sense. So if you look at it just from like the pre-pandemic and all that's been thrown at us over the last couple of years, to us, to some degree, the markets have actually performed reasonably well when you think of everything that's been thrown at it. And if you discount the fact that it just got a little bit crazy with the trading when all that stimulus money got thrown in the economy.
And believe me, we fully understand. Most folks look at their year-end statement, right? You probably look at it at different times throughout the year, but almost everybody looks at that year-end statement, and we all think, hey, that's sort of the marker. My account, my values, they shouldn't go below that, right? That's sort of psychologically we think that's now my new floor, and so it adds, right, the psychology of takes a little extra effort, little strength to say it's okay. It's not always going to stay at that level, but anticipate it will come back. So here's another one of my favorite slides, kind of building on that theme a little bit. So this, again, just talking about the S&P 500. This is going back to 1980. So this is annual returns for each year going back to 1980 through year to date. Okay, so the gray bar charts represent the year-end return, right? So for example, 1980, the S&P finished the year positive 26%. 1981 finished the year down 10%. Right, and you can come across, you can see the majority of the years were positive. In fact, 32 of the 42 years were positive. Obviously, a lot of variability, 10 years in the negative. Now, here's where I think it gets particularly interesting is the red dots. The red dots represent the largest intra-year decline. Okay, so again, picking on 1980, finished the year up 26%, but at one point during the year, there was a sell-off. It was down 17%. All right, so that's a big range within one calendar year, and in fact, that's relatively normal to have a lot of movement within any calendar year. What's kind of abnormal, maybe you can see that, is these real calm years, right, where it's very very minimal downturn. All right, last year was an example, only down 5%. In fact, the average of the red dots is 14% down. All right, so if we come over, the year to date or through the 27th of September, we're pushing again, right, to the lowest point of the year. Earlier in the year, it was down 24%. Had a little recovery in the summer months. If you'd run this chart earlier, the gray chart was not as long in the tooth, but we're pushing back down to those levels again.
Without a doubt. So one of the things is, and we get asked this question a lot, people have said there's really been nowhere to hide. And I would tell you that's actually a fairly accurate summary. People have mentioned that, well, cash, if you're sitting in cash, you're losing out to inflation, though. I will say sometimes I think that's an unfair characterization, because cash does exactly what it's supposed to, which is maintain your cash balance. Are you going to lose purchasing power? Sure. But other asset classes have gone down. Cash has basically done its job, and now we're getting a little bit of yield on money markets. But the next slide kind of shows you what's happened on the fixed income.
Alp, would you agree kind of on that point of losing out to inflation right now? One, we don't expect inflation to stay at these 8-9% levels, right, for the long term. And two, it kind of depends where you spend your money, right? Are you experiencing the inflation? Some folks are experiencing inflation in different ways, right? So if you're a renter, you may be experiencing a lot more than someone who has a fixed rate mortgage, as one example, right?
Yeah, I think that's a great thing. I know when they talk about the inflation numbers, one of the biggest things that's impacting the inflation print right now is housing and rent. And I did a little homework on that. I think it's something like 68% of the people in this country own their own home. And I think over 90% of them have fixed rate mortgages compared to previous periods when people had the variable rate loans. And so all the people with the fixed rate loans, they're not seeing any of the housing inflation. So it's a great point, Jason. Thanks for bringing it up. So this is a new slide that JP Morgan came out just talking about the volatility in the bond market, or the selling in the bond market this year, compared to 1976 through today. And so they picked all the way back to 76, because this is basically the big inflation years. We had two double spikes, and you'll see it on a chart later on. But what we're seeing here is this is what the U.S. bond ag, so the total U.S. bond market did. Same concept as the two slides ago. Basically, in 1976, the bond market was up 16%. At one point in the year, it dropped 1%. But the big point to make here is over the entire history, you only saw a few periods of bigger sell-offs, like -7, -9, a couple of -5s across the board. You see another -7, but really very little damage to the bond markets until you fast forward to 2022, and we are right at the lows right now. So we actually think one of the things that this presents is opportunity for the first time in a long time. And I just started hearing people talk about it on some of the shows that one of the famous hedge fund guys, guy runs Citadel, was saying that now you can actually get really good returns in bonds. And if stock market returns struggle for 4 or 5 years in the aftermath of a unwinding, if we just don't get any consistent growth, we should get good numbers in bonds after this sell-off. And our view is, and we'll show it on another slide, our view is the Feds are going to be cutting rates at some point. But again, the point we're making here is a lot of damage in the bond market in 2022. Very unusual year. Go back to 1976. We've never seen anything like it.
I don't think Alp is necessarily predicting 33% returns in the bond market, but
so we spoke to the team at Fidelity, and they were telling us probably about 3 or 4 weeks ago that their expectation was, they don't know exactly when it will start, but they thought in one of their portfolios, Fidelity Advisor Total Bond, which we have in a lot of our portfolios, they felt the returns on a 5-year looking forward basis without interest rates, with interest rates just stabilizing, not factoring in if they go down, which we expect them to go down a lot from where they are now. They expected 5% returns for the next 5 years, just with rates stabilizing. That's how much yields have gone up right now. So this just shows you that same thing, like across the board. You can see U.S. Treasuries, everything on a year-to-date basis is down. And this is a fascinating one, like the 30-year U.S. Treasury on the bottom half of the middle, down 33%. And those are held in a lot of pension funds to match up the liabilities of the retirees. And so a lot of damage there. Very complicated. Believe it or not, it doesn't hurt the pension plans. I'll get into that someday later. But across the board, everything else is down, like the U.S. Ag that we just talked about, corps, convertibles, high yield, municipals, all selling off. And this is the damage. And so, there's always side effects. I always talk about, like, if you're reading the warning labels on pharmaceuticals, if a company's coming out with a new product, or if you're just watching TV at night and they're talking about the pharmaceutical
side effects,
there's like a laundry list. I'm going to say this is one of the big side effects of the Fed's raising rates. And again, to some degree, I think they're not focusing on the side effects enough, but there's a lot of damage here.
Mm-hmm. And kind of back to the being in cash right now, or at any point this year, has not been a bad thing, even though you think, hey, maybe I've been losing out to inflation. But we'll talk a little bit more sort of how that plays out for different kinds of investors at different stages of their kind of investing life.
And I think the easier bounce back will be on fixed income. When I look at, it doesn't mean we go all the way to fixed income, but I'll just say I think that's the easiest recovery, because after this damage, the Feds are going to be forced to stimulate. And again, we'll show you a slide that's fascinating coming up, and I think it will be the obvious. And so this is basically just talking about the growth we've had in our country for the last 20 years. And in the old days, if you remember the 80s and 90s, at times we'd have growth that was 3.5, 4.5%. And our trend growth for the last 20 something years has basically been 2%. You see the big drop off for the pandemic. We've recovered to that trend line. And the reason I'm pointing this out, the economy, I mentioned this earlier, the economy wasn't overheating. Our trend growth is a lot weaker than it had been, from back in the 80s and 90s, as I just mentioned. So to me, when the Feds take down growth, they're going to be forced to stimulate. And this has been all in a very low interest rate environment. And you'll see a slide coming up with a lot of deficit spending.
I think it's always interesting, is I know a lot of folks know this, but here it lays out what are the kind of the primary drivers of economic growth in the U.S. Look at that. By far, 68 to 70% any given year is just you and I, all of us buying stuff, right? Just consumer spending.
So this is the 2022 federal budget. And it's interesting, the one from 2021 with all the stimulus spending, basically on the right side, they had how much was basically borrowed to maintain the budget. It was over $3 trillion. So what this slide is saying on the left side, total spending, 5.9 trillion. And they talk about how we spend it. You can see it all broken down, and this is how the money comes in to pay for it. And Jason and I, we always joke about how fun would it be to live like this, where we take in this amount, about 82%, but basically don't worry about paying off the credit cards and just continually borrowing. So this is basically saying 18% deficit, a $1 trillion deficit in 2022 fiscal year. And on the bottom right, you can see the federal net debt as a percentage of GDP. And you can see where we are. We see where we are now, and you compare it to the World War II periods. The big difference is after World War II, we did a really good job. Our economy was growing a lot, right? Growing a lot faster, but debt as a percentage of GDP went down substantially. Our economy is growing slower now, and we've gotten addicted to spending. And so previously, this thing pretty much went horizontal. Now it's starting to move upwards. When I say like the projections for the next 10 years, if we went back to slides from 2 or 3 years ago,
You said just
we're
kind of go
not going
sideways.
vertical.
Yeah.
So, which is bad enough.
We had a question. I think this is a good time to address it. Who's going to buy bonds in the absence of China? Now, of course, there's all sorts of different kinds of bonds. I'll read into this question. Government issue bonds.
So there's been a lot of people buying government issue bonds. One of the problems is I think there's been a lot of people shorting them. I'll say the automated trading programs, because it's been a trade that's just gone one way. And if you've listened to me talk before, I'm a big believer that the markets today are a lot different than they were 20 years ago, a lot different than they were since the credit crisis, way more automated trading. So to some degree, we're actually presenting an opportunity on the bond side. I think people that are saying they don't want to own bonds right now are making a huge mistake. I think that's a great place to earn returns. Again, compare it to before. You could only get a couple percent on bonds and 0% on the money market. I think high yield bonds right now, we're starting to see 8 and 9% returns. It's been a long time since we've seen that.
And in fact, the largest buyer and holder of U.S. issued bonds is the U.S. we buy most of our own bonds, and the largest.
Which is another story, though.
That's for another story. And the largest foreign government to buy U.S. bonds is not China. It's actually Japan.
Which to me is
that may change, but
things like this bother me. You may not know this. Like I sit and think about these things, and what bugs me about that scenario is Japan's keeping their rates really low and they're printing their own money. So indirectly, they're buying our bonds and we're paying them a higher interest rate compared to what they're paying on their bonds. So they're basically floating off of us, which drives me up the wall.
Let's talk about the consumer now, from the macro a little bit more down to the micro.
Yeah, so this is actually another great slide. The consumer's in really good shape, but I'll say there's a little bit of a caveat. So all of our clients, really good shape, without a doubt. Everyone's got, if they've got a mortgage on their house, they've been refinanced it to a lower level.
Fixed rate.
Balance sheets, right? Housing prices went up. Again, even though I will joke and say when people said, oh, my house price went up, like we now download into one of our programs, everyone's Zillow valuation, and somebody say, oh, my house was worth 1.4 million, it used to be worth 1.1. And we're like, well, that's kind of the story of the day. Inflation, somewhat problematic. And so again, the feds are trying to pull that number down a little bit. So remember that. But the positive about the consumer is this household debt service ratio on the top right. Consumer is still really strong. It's pulled off of the lows. So you can see this is debt payments as a percent of disposable personal income. So basically second quarter, 9.5%. And we were up before the credit crisis, 13.2%, came down a lot. We went basically sideways for a while, and then another wave of refinancing. And also in 2020, 2021, the stimulus payments people used to pay down debt. So there was some positive there. Balance sheets are good. But the part of the consumers that are suffering lower wage earners. You're hearing a lot of wage increases. Amazon, I think, just raised another $1 this morning
Yep.
or last night for their entry-level people. So you're seeing a lot of impact there, but the people that were most impacted by inflation are people that are living paycheck to paycheck. When gas prices surged over $5 a
Yep.
gallon, problematic.
Or
When the
paying rent.
rents
Yeah.
just crushing them. And so,
Yeah.
in our office, we've actually felt that wage inflation on the lower end, the lower tier workers, has actually been needed. And we'll show you a slide that we'll show you why. But
Yep.
so this is just a quick summary of real estate. While mortgage rates have moved up substantially, and now I think we're talking about 6.5% in the past month, it's jumped up that much.
Yep.
Still low on a historical basis, but I believe we're so addicted to the low rates, this is a problem, right? I mean, the housing market will not perform anywhere near as well in this high rate environment. I'll say much higher rate environment. And we will kind of say it's not that rates are low on historical basis. Rates have now gone up over 100%. You could get a 30-year mortgage for below 3%. That's now costing you above
Of
6%. And it's not like it happened over a 3 or 4 year period. It happened over 3 or 4 months or 6 months, I should say, right?
And this is just an ongoing issue, right? Housing inventories, right? That is inflationary, right? Just low supply of houses relative to demand for houses.
And this is another side effect of what the feds are doing by
raising rates. It's pushing down the
housing
housing
starts,
starts. Yeah.
right? So this is problematic. So again, I don't know how the feds get out of this. So consumer confidence, this is a really good slide. This is the University of Michigan Consumer Sentiment Survey. And all we're trying to show you here is when you see sentiment at really low levels along this bottom here across the board, what they've put next to those levels is the market rally. And so on February 1975, when the sentiment got really low, the market, so it's a contra indicator, the market responded really, really well. 22% rally. And typically when people get too confident, that's when the market starts going sideways to down. And so now we're at really low levels, pulled up a little bit, and that's because of gas prices cooling off.
Yep.
Remember, I've seen signs for under $3 a gallon now, so that's a huge positive for consumer sentiment, but still really low. And again, a good contra indicator. I don't know when the market will kind of recover some of these recent losses. I don't expect to recover all of them, probably for a longer period. But I will say this, most people don't know this, but we're about to finish the worst period, the worst 3-month cycle in the markets, typically the quarter we're about to end. And the best period starts around October 14th, October 15th. You get a lot of, I'll call it, preparation for all the new money coming into the market in 2023 from like 401k plans, pension plans, people that have maxed out and are now start funding again. So there's been this phenomenon, they'll call it the Santa Claus rally, but the markets have tended to perform a lot better. So it'll be interesting to see how that battles, I'll call it, a bear market. This also is an area that I think the feds have made a mistake on, but labor demand, I think trying to slow down hiring when there is that much of a need for workers, I think it's like pushing on a string where, we've been looking for hires on both sides of the business for a long time. And generally, we'll talk to all of our peers and we're talking to investment committees for our 401k clients. Everyone's had a really difficult time and they generally would still hire just to fill up their bench right now. So even though the feds are trying to get people to slow down, there's been such a worker shortage. I think it's just not a good battle for them to pick.
Yeah. So we're about 15 minutes out.
Yep.
Just to time check. I think we're doing well.
Unemployment and wages is what we were talking about before. So the blue line basically is wage growth. And so if you look at from call it 2000 on the middle of the page, just had subpar wage growth. It's been a long time since the 70s when you had the higher wage growth. We've had lower inflation, I acknowledge that, but we've only now been getting higher wage growth. And again, some of it's because of energy prices went up that really dictated what's happening, but also I'll call it just the worker shortage. And one of the things that's been a little bit of a positive, I think, in the August employment numbers, when they came out in early September, they showed that there's been some workers returning to the workforce. So that's been a positive. So you've seen a little bit of the wage inflation subside a little bit, but.
And I think it's worth pointing out, right? You know, the pandemic had such a impact on so many different ways across the country, right? And personal levels and so forth, but just purely from a economic, financial impact. I mean, look at that spike up. You know, April 2020, unemployment went to almost 15%. Right, like that's a serious disruption to our economy, and it's normal that it's going to take a little while to work through some, you know, a disruption to that degree.
And again, the people exited the workforce. And so we talked about inflation. So let's just kind of move ahead to the slide. So this is just the story of the year, right? So this is the history of inflation since the 70s. So you can see the double spikes in the 70s and 80s. And so this is the focus of the feds. They don't want to see inflation come under control and
like
then
it did here,
spike
and then
back
spike back up.
And I have a story of a friend that's house caught fire. It's probably 10, 15 years ago. And fire people came, put out the fire, went to a hotel the night because there was some smoke in his house, was going to go back in the next day, gets a call in the middle of the night, house burns down. And so the feds, obviously they didn't put out everything, a few ambers still burning somewhere, but the house burned down. And that's exactly what the feds are worried about. They don't want to see inflation come under control and then all of a sudden spike back up. But I'll say, I think it's a different environment back then than today. Today, we're still getting repairs to the supply chain. So I think it's a lot different of a setup. One of the positives right now, you see the inflation spiking up, but the core inflation, so this is CPI and core. Core basically excludes food and energy, which generally doesn't respond to monetary policy. But the headline number, while still high, but should be coming down because of energy, but rents are causing problems there too right now. But the core has come down a decent amount already, and that didn't happen in the prior periods if you go to the left side. So again, this is the battle. The next slide shows you the various components of inflation. And you can actually see from April 2021. So this is kind of funny, like the previous slide, like the month earlier, it showed the much lower numbers.
It's about 2.5 if you just went back 1 month.
Now, when you take a look at it, you can actually see that month over month now we're having a decline in inflation, but year over year we're still running hot. So you can this means like inflation is actually dropping a little bit, which is a huge positive. If that actually continues for a while, then inflation in theory just goes away just off of that. But this is a slide that shows you how inflation is derived, how these, like what makes it to where we get these numbers. So energy, new and used vehicles, food at home, other restaurants, hotels, and transportation, and shelter. And we've already talked about shelter being the biggest problems. Hotels and transportation, we've heard going into the fourth quarter and even parts of the third quarter, this came down a lot. And so if you look at, if you were trying to rent a summer rental somewhere, those prices have skyrocketed. My guess is with rates moving up, you're probably going to see that slow down a lot.
And there was just a lot of demand this summer, right? A lot of pent up demand, folks wanting to get out and travel. And I'm sure saw a lot of that.
If you're the food shopper in your household, you'll know the food prices have gone up a lot. But again, it's starting to cool a tiny bit there. Car prices cooling a decent amount. Used car prices coming down, still up. I think used car prices, I think if anybody sold a used car, up 40% compared to the pre-pandemic levels, and the energy prices have come down substantially. So this is actually a little bit of a lagging. We should see this number get a lot smaller in the next couple months, because as we know, gas prices came down from over $5 to $3.30, $3.40 national average. So again, shows you the inflation. And this is like the story of interest rates. So I love this chart. This shows you the periods when we've raised rates. On the left side, we raised rates trying to slow down the tech bubble. But what happened, we did such a good job, they immediately cut rates. And so then they started raising rates again going into the credit crisis. They didn't realize they're going to have a credit crisis, but it didn't take long. Then we pretty much cut rates all the way down to zero. And we flatlined for about 8 years raised rates 9 times, but took forever doing it, very slow quarter-point moves. But one of the big things that most people don't remember is we actually cut rates 3 times prior to the pandemic. So we went from about a 2.25 rate to 1.5 on the Fed funds rate. And that was because our economy was stalling at a 2.25% rate. If anybody wants a fun Google Jeremy Siegel, CNBC rants. He's been on a couple times over the last, I'll say 8 or 9 days, blasting Jay Powell and the Feds. He believes, like I do, I don't know, Jeremy didn't call me, I don't know where he got his info from, but I felt like this is the actual neutral rate for the economy. So 1.5, because that's where we were without a pandemic. You know, you see we cut it for the pandemic, but so now we've gone up 100% over it, and they're not letting the rate hikes cycle through the economy. It typically takes 12, 15, 18 months to feel the full effect of the rate hike. So I think that's the mistake, in my opinion. And my belief is at some point, you're going to see history repeat itself and then lower the rates. And one of the things I didn't mention on the Fed budget slide is these higher interest rates, the higher borrowing cost for our country. Our country has 30 trillion of known debts and getting larger every year. Borrowing cost on average goes up 2%. And I realize we have some long-term debt there, so it's not going to go up that quickly. And long-term debt doesn't move as much, but the shorter-term debt, if it goes up 2%, that's an extra $600 billion to add to the deficit. So I tend to think that's a problem.
So Alp, we got the purple dot here for the FOMC long run projection. What color will be your dot? Because you see it right in here.
I think they're supposed to go down lower. I think it'll be faster, but again, we'll see.
We need to.
You know, they are being very hawkish, meaning that they are saying the same thing over and over again. So again, this just shows you like the history of, you know, the 10-year Treasury yields. And so you can see how they were going lower since 1980. So like a 40-year pattern of going lower. And the problem now is with inflation where it is, there's actually a negative yield here. And it's difficult to explain. Some people believe that shouldn't be around, somewhat like it should get priced more, like for the Feds to correct that, they're going to have to raise rates and keep them higher, but I'm going to guess we're going to stay lower for longer. But you can see we've now spiked up in a very short period of time. The 10-year Treasury yield, this is the return, 3.96% on September 27th, but inflation adjusted with these high inflation prints, you're still losing money at 4%, but I actually don't think that's a fair comparison. I'll skip over the oil markets to save a little time, Jason, and I'll just talk about commodities in general. One of the things that we've seen almost immediately when the Feds raised rates was commodity prices have come way down. And I'll give one that's not on the chart, but everybody is easy to understand. Lumber prices related to the housing markets had spiked up to about $1,700. I think it's for 1,000 linear feet. That's now down around $400. And so you've seen commodity prices across the board come down. Like one area that's been really stubborn, I'll just say because it's the obvious, electric vehicles. So think lithium ion batteries, like that basically is like in huge demand right now. So that has not come down, but across the board, you've seen a lot of it. Like you've seen a lot of things that have come down to below, I'll call it the pre-invasion prices. So even after, you know, Russia invaded Ukraine, prices had spiked up. They've come down to below those levels. So again, inflation for commodities has come down substantially. So this is like a sore subject in the office. This is U.S. equities outperforming international equities. We love the fact that U.S. is dominant, but what our concern is at some point, you're going to see history repeat itself. And so the question is, how do you position yourself for this? And we debate this every day, but I'll point out for those that are still working and they have target date funds inside their 401k plans, the target date funds, Fidelity, for example, is holding 45% international exposure in their target dates. Some are holding 35, some are holding 40, but they're holding huge percentages in international, expecting this to reverse out. And
just a quick explanation here, right? So this sort of dark gray color just shows the length of time and degree at which the US markets have outperformed the international markets, just at broad index level comparisons, right? So going back to basically, the 2008-ish, coming out of the crisis, right? They kind of moved it together for a while, and then it was just a breakout performance, and still US centric. Prior to that, the international markets you see here had outperformed. You just kind of see this cycle, right? So to Alp's point is, well, when does this cycle reverse out?
And like one thing that's and we'll talk about it in a slide, but it's just really the dollar, the strength of the dollar. A lot of this is literally dollar related, that the dollar has basically been the reason for the outperformance.
Yep.
So international valuations are actually really, really cheap now. So this is international price to earnings ratio. Always sold at a discount on average around 15%, but right now they're selling at a 30% discount to the US market. So really reasonably priced, again, because of the strength of the dollar. And the dividend yield overseas, right now, the dividends on the international stocks, which is great for retirees, 1.9% premium compared to the US dividends. And so nice positioning for retirees.
I'm going to take this opportunity to kind of address a question we'd had, just thinking about allocation advice for retirees or pre-retirees, somebody getting close to retirement. And just, one component why I pick on this as an example of why it can continue to make sense to hold international allocation, not just from a diversification perspective, but also because of the higher dividend yields, right? In retirement, most retirement portfolios want to generate income, right? And so it can make a lot of sense to continue to have a healthy allocation in international funds because of this higher dividend yield contributing to the fund. Alp, what else would you say? Some good just basic advice, and good in any time period, but specific to now for retirees.
Well, I would say it's a great time. I brought it up earlier just to look at it very long term in nature, first of all, but it's a great time to pick up fixed income. And we get a lot of questions like, well, is my portfolio too aggressive? I'm in retirement. If for somebody that basically is only taking their RMDs out, the required minimum distributions, so that essentially they're living off of other assets. In that example, it's really easy to take a very long-term perspective for the money in your retirement account. And a lot of our clients will tell us that they're investing for the next generation. So in that example, you kind of just factor out the noise. So
I would add that a lot of it is certainly the approach to the portfolio shifts, right? When you're working and you're just adding to it and growing it, right? Not dependent on the income, right? When you then shift to, hey, now I'm kind of drawing it down, whether it be kind of the minimum required amount or above that, it makes sense to kind of start to think about your portfolio in a few different buckets or sort of sections of, okay, what's the income need that I have out of that portfolio? Right. And we often sort of look at that as the foundation for, okay, how do we build the portfolio to ensure that we've got enough runway of cash or, very, very low duration, short-term kind of fixed income to cover maybe 2, 3, 4 years of that income need to be able to weather a cycle in the equity markets or in the longer term bond markets to be, hey, in a down market like this, not being forced to have to sell things that are down to create the income that you need, right? Sort of build that runway or buffer of short-term cash. That's just kind of one of those sort of basic truisms, if you will, for thinking about building out a portfolio in retirement.
Without a doubt. And this is a great slide just on the various asset class returns since 2007. And you can actually see where I'm showing real estate investment trust in blue, REITs. They think of like declining interest rates and how property values have gone up. And so that was really good for real estate related activities. No inflation was really bad for commodities. You can see on the bottom. So this is a combination of, I'll say, better equipment in mining. So a lot more capacity to just pull out whatever we need commodity wise with no inflation. And so now you compare it to now with inflation, commodity prices are leading the way in 2022. So you can see the various asset classes, how they've performed over the years. But the big message is you've got to stay diversified, because if you're in a diversified portfolio, you just hover around the middle generally.
All right. Yeah. Try to avoid the the extremes. So I know we're at noon. I know this is a very hot topic. You want to take a moment, talk kind of
So just
the dollar.
The dollar's been just on a rally. And so the dollar's always a safe haven play. And so everybody, let's say the traders all know it, so they just keep pushing it higher and higher and higher. However, this is a byproduct of like the Fed's raising rates. So our US treasuries look really attractive. You want to be in dollars right now. So people want to buy dollars, strong currency right now. The problem with that is the rest of the world is getting really frustrated right now. And if you might say, what do I care about the rest of the world? I'm going to say it matters in a global economy.
We're all interconnected.
And so the question is, will there be some type of correction here, a fast correction at some point? So the last time it spiked up a lot, you can see how fast it came down. And that's one of those periods that the international stocks did really well. So again, like we showed you a couple slides that indicated that history has repeated itself. Not exactly, but it rhymed a lot. So will we see the same thing happen here?
Good time to afford the European vacation.
No question. That's a good side effect of the dollar strength, without a doubt.
We'll probably skip this
Same
slide.
thing. Yep, I agree.
Yep. Yeah. So I think kind of similar to the earlier question that we had about kind of portfolio structure for the retirees. Alp, let's talk for a moment about kind of best advice we can give younger investors, right, that are watching. I think a comment I think each of us have received, whether from different clients or children of clients, or kind of regardless of age in this current market, is, gosh, every dollar I'm contributing to my 401k, then I look at it the next day or the next week, it's worth less. Right? So why should I keep investing?
Yeah. So whenever we've given presentations to younger audiences for 401k plans and just talking to the younger clients, it doesn't sound good to hear, but this is actually what they want. I hate to say it, but like the bear market is the opportunity to put more money in at cheaper prices. They don't want to constantly be investing their 401k into a higher and higher market. So the bear markets give them opportunities to add more exposure. Unfortunately, what we're seeing and hearing on CNBC is the younger investor has been bailing out of the market. And generally what happens when somebody bails out, they don't get back in until the market goes up, I'll call it 30, 40% from where they sold out of. So maybe they saved a little bit of money over the short haul, but for us, for the younger investor, you have to look at this type of period as nothing but an opportunity. It's a lot different than people my age, where you kind of want to sail into the retirement years and you want to just have fantasy growth in your portfolio every year. You want to see 6, 7, 8% growth, which doesn't happen.
But especially for the younger investors, just repeat this quote, this Buffett quote.
Right, without a doubt. One of the best quotes out there. And Buffett is buying right now, as just so everybody knows. He's for the last 5 months, he's been spending a lot of his cash forward.
So let's wrap it up with some of the final thoughts, Alp.
So it's all about controlling inflation. So we're not really going to get through this until we see inflation in some way, shape, or form come under control. Jay Powell pivot at some point if he thinks that he's been too hawkish, and if they start changing their language a little bit, that'll be a positive. Could there be more downside? We get asked this question a lot. We're right now at a level that if we break below it, we could definitely see a little bit more downside, and that could be another 5 or 10%. But at some point, we expect that to reverse out, because we make the comment that over the long haul, whether it's a correction or a bear market, the market remains undefeated over the long haul. It has always gone on to higher highs. It might take time, but it has always gone on to higher highs. In this case, as I mentioned, it's a little bit different. The government, we're trying to kind of pull down the market. We're trying to take stimulus out of the economy. So at some point, you're not going to have the feds pounding on the brakes. So as I mentioned, I think lower rates are going to return. And I've been saying it would not surprise me, and Jason kind of tested me on it earlier, to see them come down to where they were, that 1.5%. And it's a totally different ballgame. But inflation's a difficult battle. We've had it before. I had somebody talk about on a show earlier, the inflation we have today, how similar it is to the post-World War II period, where there was a lot of pent-up demand then, and there wasn't that much supply because they had literally converted all the manufacturing to making
For the
all the
war
military,
effort. Yep.
right? So they think this is fairly similar there, and so they think this inflation should come under control. And as we've mentioned before, the wage inflation, on the positive with wage inflation, especially on for the lower end of the curve, all of that comes back into the economy. And we felt for a long time that people making wages of a certain level, it's really difficult for them to make ends meet. So I think this is kind of like a long overdue correction on that side. But anyway, final thoughts, longer haul, we think the markets will recover. We just don't know when.
And now is a good time to focus on quality, right? I mean, kind of thinking about, again, back to Warren Buffett, right? Like he often talks about, he wants to invest in companies that he believes are well run or profitable, good quality companies. And if they go down in value in a time like this, unless something has changed in terms of his assessment of those criteria, right? A wide moat around them, right? That they're well insulated. He welcomes that. Hey, this is an opportunity to buy more of a company that he likes, thinks is well run and will be profitable in the long run.
Most of us don't have
Buffett
that close
degrees
to
of
Buffett
money.
money. But I think that the point is simple. It goes back to his quote.
So, well, thanks for sticking with us, everyone. I know we ran a couple minutes over, covered a lot. Thank you, Alp. Get a drink, get a sip of water. Check out our website. That's where you can find the recordings of various webinars, workshops that we've done in the past, different one-pagers and infographics. So please check that out. Like I said, this is being recorded. We will send out the recording. Feel free to share that with family, friends, so forth. And as I mentioned at the start, don't hesitate to reach out if you have questions about anything we talked about today or any other subject, or like to schedule a time to connect. I know some folks already acknowledged that you're on the calendar, so I look forward to seeing folks soon, talking to everyone.
And one last thing I'll say, Jason, if we haven't answered your question on some of the ones that we got that we thought we might have answered, we will reach out to you directly.
Absolutely. Yep. All right. Well, we'll leave it there. Stay safe, everyone. Enjoy the weather today before the rain. I think it's coming soon. All right. Take care.
Sure.